Srimatri Namaha. Welcome to Ajitaha IAS Academy. Myself Ravi Shankar, and sorry, we are continuing our session on the economy current affairs for the prelims. Okay, in this video, let us discuss about the capital account convertibility. Convertibility means able to transform it into some other form. For example, if you have 100 rupees, if you are able to convert into dollars, you might get something like $1.5, something like that, based on the exchange traded platform and all. So if you are able to freely convert, it's called convertibility. If you have 100 rupees, you can truly convert. You can completely convert it. So that is called as a full convertibility. However, if you have more than 2.5 crores, for example, that was the maximum limit. You can convert 2.5 crores in an year. Okay, that was per annum. If you have more than 2.5 crores, you cannot convert. You can only convert after getting the RBI permission. RBI usually will not give. Okay, that's a different aspect. However, so putting such a kind of restrictions is called as a partial capital account, partial convertibility. If it is in the case of a capital account, it is called as a partial capital account convertibility. If it is in the case of a current account, it is called as a current account convertibility, partial or fully. So you need to learn about the capital and the current account. So current account means that deals with the daily transactions. Capital means which brings in capital, that is investment or so something like that. Okay. So for example, FDI, FFI. Okay. The Anyways, I will make a current video on current account versus capital account. For this video, let us restrict our understanding with respect to capital account current account to the FDI, FFI, as I have already mentioned in the video, marquee account, marquee investor. These people bring in money to invest in the companies in the form of technology or stock markets, or giving debts or loans to companies, because companies want money because they have the what do you say, logic, and they have an idea to prove and to make money. These people have money, FDI, but they don't have time in finding out ideas, and they don't want to take that risk. They just want to focus on investing money. So these are the FDI. But when they want to go back to their country due to so much of global uncertainty, for example, markets and all the stuff, especially in the case of COVID, if they pull out every huge amount of money from these countries, government has to give back in pay them in the form of dollars, right? So our foreign exchange and stocks will come down. So we will not be able to import the necessary goods, for example, oil or other food products, for example, grains and other necessary medicines also from other countries. So that's why RBI is not giving approval for the full capital account convertibility. However, in 1997, Tarapur Committee recommended the full capital account convertibility. For 1999, they recommended at this time 2000, but they recommended based on the fulfillment of certain benchmarks that are related to the fiscal deficit. Fiscal deficit means that, what is term deficit? Fiscal means if government have huge amount of debt, don't go for capital account. Inflation, if we are having huge inflation, that is, if you have if 1 kg an onion is 10 rupees, it is okay. If the cost of the onions is 100 rupees, 110 rupees, it will be very tough, because nobody in the global markets would buy our onions, and we don't get dollars. Then how can we replace the dollars which went out of our country in the form of the investors taking their profits? So inflation and non-performing assets, because non-performing assets, how these are related, we will discuss another. But there are certain parameters. It is not just related to these aspects. Okay. Committee on the Fuller Account Capital Convertibility in 2016, another again, it is called Tarapur Committee again. They suggested measures for gradual capital account liberalization. But because ultimately a capitalist economy, that is a free market economy, have to move towards fuller capital account convertibility, but we should not move at a single shot. We need to understand the other parameters of the economy. Otherwise, what happened in the tiger economies, especially East Asian economic crisis in the 1980s, might happen. Okay, so taking the lessons from the history is a good way of making a strategic decision making, especially in the case of the economics. Okay, So convertibility refers to the ability to convert domestic currency into foreign currency and vice versa to make payments for the balance of payment transactions, especially the trade. A full CAC allows local currency to be exchanged for foreign currency without any restriction, and India have partial capital account convertibility. But for current account convertibility, especially when I was mentioned about the oil, it was a current account only. At that time, you can translate how much amount. However, for capital account, those who have invested in our companies as an investor, they cannot take the whole money back. Okay, that's what. And we will discuss more concepts in the coming videos. Thank you so much. If you have any questions, please comment and we will make them a video or we will explain to you. Okay, thank you so much.